Good afternoon, everyone. How's everyone? Have we actually got any traders in here today? Anybody actually with skin in the game? Money on the table? Not very many. Okay. I was asked to do a very quick presentation, so technical indicator. I can't hear myself. That I've used for as long as I can remember, really, and why I use it is what I was wanting to explain today. Something called the ATR. I first came across it when I read a book about Richard Dennis. Hands up, who's heard of Richard Dennis? One hand. Oh dear. I'll tell you about Richard Dennis, the king of the pit, or the prince of the pit as he was known in the 80s. So this is us, ATR, legal stuff. This is me. I worked in London for 20 odd years, worked for a retail bank, I worked for an investment bank. I was a school teacher for a few years. Economics and geography is my background. But I've been trading and investing for well over 20 years. It's a long story, but it was the death of Princess Diana that got me into trading with my real money, but that's a story for another day. So for me, trading is a mindset. It's a mind game. It's a psychological business. If you don't know yourself, stop now, because you'll never make any money. You'll just give it to the brokers, legally or illegally, as our friends just explained. So it's a probability game. Don't like talking about it as a game, but it is a game. It's a mindset. It's a mind game. So today I'm going to talk about the average true range. I'm going to explain what it is. It's very simple, which is why I like it, because I'm very simple. It works. It's effective. It is what it is, as people say these days. The formula, how to use it, 3 key areas to use it. You can use it for all sorts of things, but like any indicator, it's just an indicator. It is what it says on the tin, as they say. As I say, I've been using it for years. It's raw. It's absolute. It's neither negative nor positive. It is what it is. You can't argue with it. I'll explain how they've created it, how Wells Wilder created it, and how it's so useful. So Richard Dennis was a very, very, very successful commodities pit trader in the early 1980s. He had a discussion with his partner, a guy called William Eckhart. Is this how long I've got left? Yes, must be, yes. About the idea that traders could either be taught or it was something they could do intuitively. Dennis had learned to trade in the pit. He got himself to the top of the futures pit trading. And they put this advert in the Wall Street Journal. And they got all sorts of different people applying. Very long story. I'll cut it as short as possible. 23 people successfully went through this training exercise that Eckhart and Dennis put together, and they all became multi-millionaires afterwards. Some people fell out of it. Some people couldn't take the pressure. It was a very, very simple trend-following strategy. Basically, in a nutshell, you get into an asset when it's at a 20-day high. You get into it again. You buy it again at a 55-day high. It's very strict risk management, 2% risk management, and they use something called N, which is similar to the average true range, but it's not quite the same. But they use an N value for trading. Legend. If you don't know who Richard Dennis is, look him up. William Eckhart, also a very, very good and successful trainer and teacher. And this strategy now works as well now as it did in the 80s. Very famous people, traders, companies, hedge fund managers are still trading the principles that Dennis taught them 30, 40 years ago now. So based on one of the key principles was volatility at the time you took the trade. And that's the key thing about the ATR, the average true range. So it was developed by Wells Wilder, very technical, competent futures trader. He developed lots of other very successful indicators, technical indicators for geeks like me that like technical indicators. And the ATR, which is one of them. It's a volatility indicator, and it's non-directional. It can be sometimes difficult to get your head around that. Non-directional. It doesn't matter whether it's going up or down, the indicator on the bottom of your chart. It's how volatile it is. Is the volatility increasing? Is the volatility decreasing? It decomposes the entire range. What does that mean? Well, it takes in the gaps in the range. So range is fairly straightforward, isn't it, of a day? High and the low, that's the range of this price asset, of the day, of the week, of the minute, whatever it is, whatever time frame you're trading, something will have a range. The average true range takes it a little bit further. It takes the gap, if there is a gap between the minute or the hour close or the end of the day to the next following day. You quite often get gaps, don't you, in stock markets. Netflix last night reported earnings. They were up they reported earnings during the day. So their earnings actually they went up a little bit, closed the day down. After hours, that accrued 14%. Obviously, you can't trade those stocks, but on the grey market, the stock accrued 14%. So what the ATR does, when it opens today, there'll be a gap in the price of the Netflix stock. So what the ATR does is capture that range. Very, very, very important. We'll look at the maths in a minute. So Wilder's maths is this, okay? So it's the biggest gap is what it's trying to capture between A, B, and C here. So between the previous close, the current high, the previous close, and the current low, and the current high, and the previous close. So it's the trading range. So whichever is biggest, that's the gap. That's what creates the average true range, or the true range, if you like. The average bit comes from the smoothing of these things. So if you do this over 15 days, you'll get a 15-day average. So that's what's on the bottom of your line. If you do it over 15 minutes, you'll get the average true range for the last 15 minutes. So it depends what's on your chart. So typically, this is an MT5 platform. This happens to be the NASDAQ. So it's plotted as an oscillator down here, ATR. So this is the NASDAQ. It's got an average true range at the moment on the daily time frame of 355 points. It's useful to know that sort of thing, isn't it? So over the last 10 days, the average distance the NASDAQ has travelled each day is 355. So that would be quite useful, can't it? Depends when you open your day for trading. If it's already moved 300 points on the day that you open it, and the average over the last 10 days is 355, do you trade it that day? This particular setup, I've set it for 10. Doesn't really matter what it's set for. Wilder set it for 14. That was the common parlance back in the 70s and the 80s when a lot of these technical indicators were getting put together. And I just fiddle around with it from time to time. And the other thing that's worth pointing out is that Wilder developed it for the commodities market. So some people think, well, it might not be appropriate for other markets. It is. It works on all markets because it is what it is. It's that rawness of the move. It's the rawness of the absolute numbers that the thing has moved. Okay? So fairly typically, 6 key things. If volatility is high and increasing, think about it. It makes sense, doesn't it? If volatility is increasing, things are moving up and down a lot, the chance of a big move from this volatility is generally higher. Not always, but generally it's higher. Conversely, if volatility is low and not a lot's going on, everybody's a bit bored, nothing's moving around, it's not moving very much, everybody gets up and leaves. The volatility is quite low and things don't move very far. Okay? Doesn't always happen, but we'll see on some charts. I first came across it and started using it on a regular basis as a stop loss and as principally as a target setting first rather than stop loss. But it's obviously used for stop lossing, creating stop losses, creating targets, trailing stop losses, fixed stop losses, multiples of the ATR, fractions of the ATR of the particular time frame you're trading. It varies from asset to asset, obviously. And it's great for capturing absolutes. There's no point if you're trading, a euro dollar, for instance, has a very different volatility to the pound against the yen or the Aussie against the yen. Moves around much differently. So having a fixed target in pip terms or in stock terms and pip terms doesn't make any sense logically. The ATR gets you all over that. It's a very useful way of creating risk and reward setups. So if you're looking for a target that's 3 times your stop loss, there's a 3-to-1 risk-reward ratio. We'll come more onto that in a minute. Only got 5 minutes left. So stop losses, fixed and trailing. It's good for filtering stuff out, I've mentioned already, and works across all systems as well. Whether you've got a trending system or a mean reverting system, works across all systems. So typically, this isn't always the case, and I've said, remember, it's not a trending indicator. It's not just because it's going up, market's going down. It's measuring the volatility. It's measuring the amount of movement in the candles. So the bigger the candles, the bigger the movement. Size matters with the body of a candle. Body of the candle's big, there's lots going on. Much more interesting than small candles. So the ATR captures that. So as the volatility is increasing down here, because the size of the candles increase, so we've got a very strong trend. It's not a trend indicator, but it's measuring volatility of what's going on. So the volatility has increased, so the downward movement has increased, the volatility of the move down has increased. We've got big candles, we've got gaps in the market, so that's another great way of how the ATR will capture this move. So we've gone down slowly, and then we've accelerated as the value of the ATR has risen. When we've got flat consolidating markets, you tend to get, not always, but low volatility means low ATR, consolidation. And we all know, there's only two people put their hands up and said they're traders. All traders will know the longer something consolidates, goes sideways, the bigger the move out of that sideways action may be. And that's exactly what's happened here, hasn't it? Ba-dum. It's gone up. But as I say, not always. Here we had a very volatile, what's this? This is 15 minutes on dollar Swiss. So volatile 30 minutes. Data's probably come out. Market hasn't agreed with it or disagreed with it. So we've had a big rise in volatility. Because of its absoluteness, it's very good, as I said, for setting targets and stop losses. So on this example here, let's assume this has triggered a short trade where the yellow vertical line is. So 1 times the ATR is R.1, 2 times the ATR is 2, and 3 times the ATR is line 3. And we get that from the time the thing's triggered. This happens to be, again, this is what's this? I can't see what the time frame is, but it doesn't matter. Because the volatility, and this is where the turtles not came unstuck, but had the problems with. The volatility at the time the trade is taken. So at this point, the volatility is this point here. So whatever that is, I can't read that, I'm too close to it. So you follow the rules, okay? So there's your stop loss 1.2 or 1.3. I like and have used 1.3 as a multiple of the ATR. Very useful on an end of day basis. Intraday basis, I tend to use 1 if I'm using a trend following strategy, simply because it's usually triggered over certain other indicators, moving averages for instance, and therefore the chance of it moving at least 1 ATR is very, very high, because that's what it is. Remember, it's already done that. That's the average it's done over the last 14 or 10 or 20 periods, whatever it is. So that's the stop loss. Bring the stop loss down, and this is obviously in trending markets, it's all nice and simple, isn't it? When the market's going sideways, we'll show you all the systems for that as well. I've only got a minute left, so even I've overrun. I apologise, organisers. She's not listening. Don't blame her. So, using it in conjunction with like a crossing, a very, very simple crossing strategy. So, crossing, moving average strategy. Here, one setup, the 3 moving averages cross, you take the trade, you trail your stop loss up, and you just keep going till it reverses and you get stopped out because you close under the middle moving average. By setting an ATR target, you could use it a different way by using your stop loss around about 1.2 of the ATR and your target at least twice that, 2.5 of the ATR, and that works quite effectively as well. As I say, on this particular strategy, those of you that are bit sharper. You can see that's triggered at the white candle and rallied all the way up, so it's just stayed in till it's gone up under the middle yellow line. Another way of doing it is, I think we're on that previous strategy, is to take it as the move goes. So you take one ATR at a time, get out. Is the trend still with you? If I go back to this one. So if we'd taken it here, using the ATR approach, taken one ATR out of our target, our stop losses come up. Yes, we've bagged those profits. Is the trend still in place? Yes, because the moving averages are still in alignment. Moving averages are still in alignment. Take another ATR. Is it still in alignment? Yes. Time's up. We take another ATR. So maximum of 3 times on an intraday basis on anything under an hour, 15-minute, 5-minute charts. Works very, very effectively. If you want to use it as a scalping strategy, I would take the ATR out and just wait for it to return through to the moving averages. But anyway, trending strategy, intraday. Simple crossover, moving average. Filters. I've run out of time, sorry. So, as I said at the beginning, what's the daily ATR of this thing? Is it 100 pips? If it's already moved 80 pips today, is it worth taking the trade? Keeps you out, okay, and gives you a bit of a thinking time. Or is the movement, is this an exceptional day? Is it going to do 160? Remember, the 100 is average. The ATR might give you some indication of what's going on. So stay in, stay out. As I said before, obviously the ATR is an absolute number. So it's different for different assets. It works across all asset classes. Everything from cryptos to commodities to stocks to Forex. Is the volatility high or low? Are we trending? Are we consolidating? What's the market doing? What's the ATR? How can the ATR help us to tell us? Are we about to break out? Like we had that, as we had here, the ATR wasn't really telling us no volatility, stay out. But it's watch and wait, isn't it? Because the longer this does this, we could have another move like that, either back that way or down that way. We don't know. But sometimes the ATR can be a bit of a leading indicator of what's about to happen as the first candle break starts to pick up. And that's exactly what's happened here. We've had a lot of sideways action, very small candles, very small ranges, but then all of a sudden the range picks up. The candle's small, that's our first indicator something might go on, and then bang. That particular candle is a very bearish candle, so you would have perhaps gone in there if we've broken out of the range as well. The ATR has helped us because we've suddenly spiked up from a consolidation. So it's a very simple, very effective indicator that's on all my charts, whether I'm looking at trending markets or mean reverting targets, markets, or whatever the market happens to be doing. And it's incredibly powerful. It's been used and proven for years and years and years. And it, as I say, it is what it is, which is why I like it in particular. So, for instance, yesterday's ATR for the Swiss franc was 100 pips. We come in this morning. On an hourly chart, it's only 12 pips. So how far of that 100 pips have we already moved? This morning, it'd been, I don't know, something like 20 pips. So there was clearly some more movement, potentially, according to the average range we'd moved over the last 10 years for the Swiss franc to move further than it had already moved at, 4 o'clock this morning. Obviously. So again, we could be waiting for that movement. What's the ATR telling us on the hourly chart? Volatility is actually falling, isn't it? Which is what you might expect over the Asian session. It's not a great deal of Swiss traders sat in Switzerland trading Swiss franc at 4 o'clock or 2 o'clock in the morning, is there? So wait for the break, see what happens. And again, it works on all types of systems, whether we're going trending systems like the top two, or we've got mean reverting systems, and a bit of a trending systems down here with the awesome oscillator, Bollinger Bands and stochastics, trending, moving averages, and simple Heikin-Ashi candles, colour change for getting in. Very, very powerful little system, little indicator. I first came across years and years and years ago, and it's always on my charts. And I love it because it is what it is. I know it's a horrible phrase, but it is what it is. and it works very powerfully. You can't argue with it because it's mathematics. That's how far it's gone. That's how far this thing you want to trade is gone. Is there any more legs in it? Okay, so how volatile an asset is, all about risk management. Bigger stop losses if the ATR is high, tighter stop losses if it's low, if we've got consolidation. It's not about direction, it's not about price. It's great for both trending and sideways markets. It's most powerful tool as setting targets and stop losses, multiples of the ATR or percentages of the ATR. And, you know, obviously, Wilder set it as 14. It comes out of most trading software packages as default 14 periods, whether it's on a minute chart or a monthly chart. Obviously, if you change those parameters, below 14 gets on above 14, the sensitivity obviously changes, and the movement of the line tends to flatten out. So there we are, ATR. It's been around a long time. Go and find out who Regis Dennis is if you don't know. Well worth reading about. Okay. On our stand, we've got a free trip. If you scan the code, free trip to Paris, see PSG play, VIP tickets, accommodation, flights, all included. If you haven't been to Paris, it's a fantastic city, even if you don't like football, but the stadium itself is fantastic when there's no footballers in it. So when it's full of people, again, after COVID, fantastic experience. So come to our stand. We're right next to the other speaker hall, and scan your the QR code, and the very best of luck. Find out tomorrow. Yes, tomorrow we announce. Yep, so tomorrow when we're done. So thank you. Time up. I don't know how many times up, but try to keep it short as I could.